You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
When you see silver and the miners, they lead the gold price in both directions, right? They were leading the gold price higher. And now they've started to show relative weakness. And that's always a warning that the gold price probably has some more backing and filling to do.
Welcome back to Mining Stock Education. I am your host, Bill Power, speaking today with my friend David Erfle from JuniorMinerJunkie.com. He's a multi-decade veteran pro investor at Junior Resource Investing, and he also follows the gold price on a daily, weekly, and monthly, quarterly, annual basis. Dave, give us your thoughts on the gold price and the silver price, and how are the miners performing relative to the metals price, please?
Yeah, Bill, always great talking to you. Really interesting last week. Well, actually before last week, the Friday before last week, we had that huge reversal in the gold price after the gold price ran up to $4 below its all-time high of 2089 in gold futures. And that was basically a $100 move it had that week. And I think when Powell reiterated that, hey, we changed the language, hinting that there might be a pause soon. I think there was kind of a sell the news moment, even though the jobs report that was released on Friday was noted as the catalyst that reversed the gold price. But the miners really held up well. The gold price was down $40 that Friday, and the miners really held up well. But then the following week, which was last Monday, right out of the gate, both silver and the miners began to show relative weakness to the gold price. And that was warning. That was a warning sign that we're probably going to see some more weakness in silver and the miners here. And their short-term run, they made a higher high, might be over. And sure enough, on Thursday, we had that huge red candle in both silver and the miners, while the gold price remains well above the $2,000 level. So basically, the U.S. dollar is showing signs of basing here. It has a head and shoulders top on the weekly chart that looks like it's going to be negated. Both silver and the miners are reacting to the dollar basing, but the gold price continues to get some safe haven bids on what's going on with the recent financial crisis and the debt ceiling. So it's interesting to see what's happening here in the space, because when you see silver and the miners, they lead the gold price in both directions, right? They were leading the gold price higher. And now they've started to show relative weakness. And that's always a warning that the gold price probably has some more backing and filling to do after it had its huge move. I mean, if we take a step back and look how far the gold price went from its triple bottom in November at 1620, it went up over 32% in 6 months. And that's a huge move that needs to be digested. And it also became overbought. So, and if you even take a step back even further, that all-time high of right below 2,100, that's the third test that it's trying to break out from. In commodity markets, if there's a strong multi-year resistance level, the third try is usually thwarted, and it backs off, and it needs to create enough strength and a strong enough bottom for a breakout to come later. I think that's what the gold price is going to do here. I wouldn't be surprised to see the gold price lose the 1975 level, which it needs to stay above to maintain this bullish bias here. So if the gold price can remain above 1975, then it maintains its bullish bias. But if it loses 1975, I think it's going to go down to 1950 pretty quickly. And I wouldn't even be surprised if it eventually tests 1900 before we get another test at that all-time high.
And what will be the catalyst to thrust it through that 2089 price point? Would it be Fed policy and gold's reaction to it?
Yeah, we need a really strong catalyst for that breakout. And we need a strong catalyst, a strong sustaining catalyst for a breakout to be sustainable. So absolutely, a Fed pivot would do it. And I don't see that in the near term, and neither does the market anymore. More in the near term might be a pause, but 75 basis points is being factored in by the market before the end of the year, 75 basis point pivot in total. The last time we had a close call on the debt ceiling like we're having right now was back in 2011 when the gold price was making all-time highs. We defaulted for like a day, I think it was, and that was when the gold price hit 1925. And, of course, they made a last minute deal, which they usually do in these political situations. They make they wait till it runs up to the last minute and they make a last minute deal. But this time, President Biden has announced something really scary, which would be invoking the 14th Amendment. And basically, if he did that after they make a deal, that would mean that we would have no more debt ceiling. And if we had no more debt ceiling, this is the world's largest economy. Having no debt ceiling, the credit worthiness, we'd be downgraded right away. And they'd be able to spend as much as they want. And that would send us down the road to hyperinflation. These are all things that could break the gold price out. And I haven't even mentioned a geopolitical catalyst, which you would never want that to be the reason. War. You never want war to be the reason, but war is the reason why we have this continued inflation that won't go away. So there's all these catalysts on the horizon that could break it out. But a stronger basing U.S. dollar, if the U.S. dollar on the DXY can rise to 104, 105, that might be enough to get the gold price down to that 1900 level for a test of its recent uptrend. So I wouldn't put that aside now that the silver price and the miners are hinting that we're going to see more gold weakness.
Dave, with this macro analysis, big picture analysis, did you make any movements in your junior gold portfolio, or because you've had this the big picture perspective for so long that your position, you're sitting tight?
I'm sitting tight. Yeah. It's really frustrating. My subscribers and I, we had all these gains for the year, and they were basically taken away in a week. And that's basically what happens during these consolidation processes. It's really low volume. That's another thing to mention here on the sell-off that happened last week. The volume really wasn't that high. And if you take a look at the volume spikes when the gold price goes up, the volume's higher on the days that we have those big up days than it is lower when we have the big down days. So you're starting to see these subtle hints of accumulation taking place in the mining sector, but the generalist retail investor is still nowhere near this sector, and that is showing up in the really low volume that continues to in this space.
So Newmont has entered a definitive bid to acquire Newcrest, the Australian miner, and they're trying to run away as the preeminent gold producer by a long shot. I just want to read to you a couple of the production numbers here. 8 million ounces of total combined annual gold production once they finalize the merger, annual copper production of approximately 350 million pounds, and then 148 million ounces of gold reserves and 179 million ounces of gold resources. So if you add up the reserves and resources, that's 327 million ounces of gold in those categories. That's big, Dave. When we talk about investing in 1 to 2 million ounce gold developers, what is your thoughts on, number one, this transaction right here, what it means for this sector, and then are some of the producers, are they looking to acquire other producers, or are they still in the market for projects?
Well, this is great for the sector. Well, we've talked about this in the past a lot. It needs to consolidate. We need to attract these retail investors who've been out of the sector for a decade. They left in 2013 and they haven't returned. They want dividends and they want strong returns and they want liquid companies that they could feel safe in while the gold price goes higher. That's what this does. It creates a gold producer that is in a league by itself, because the second gold producer behind it now is Barrick, will be producing half as much gold as Newmont now. And this is a company in Barrick that tried to take over Newmont, 4 or 5 years ago. And they ended up together forming Nevada Gold Mines instead, which I think combined is Nevada Gold Mines, if standalone company, would be, I think, the 4th largest. So I know Bristow has come out and said that they're looking to grow production. They're looking to buy mines. They're going to have to make a deal now. I think so. It's going to set off some more M&A in the sector. It already, we had another deal announced today, a really small one, where Silvercrest took over a penny Australian junior. But I expect to see more bigger M&A deals later. and following this, and especially, sort of creative mergers and acquisitions in the junior space, which needs to continue because there's just too many of them. There's only so many checks that capital markets can write. The capital markets remain pretty tight. There has been some impressive bought deals taking place in this really tight market, but that consolidation needs to continue, and I think it will. But this is very, very good news for the sector. Absolutely.
When you look at a gold optionality play, and by that, for those that don't know, I'm referring to gold in the ground that will be revalued as the gold price goes up. How big does the gold resource have to be for you for it to be considered an optionality play?
Yeah, it's changed for me now. I mean, I'd like it to be at least 3-4 million ounces now. 2 million ounces doesn't cut it for me, because I don't think it cuts it for the majors and the mid tiers that are out there sniffing to grow their reserves. And if you look at the prices they're being valued at right now, an ounce of gold in the ground for these juniors is still being priced at less than $40 an ounce in top tier jurisdictions. They've got multi-million ounces in top tier jurisdiction. That's all it's being valued at. And we saw takeovers at $1,000 and higher back in 2011 when the gold price was lower. So I know it's coming. I just don't know when. This is another setback as far as the mining space is concerned. But it's just more consolidation that needs to take place, not only in the gold price, but more consolidation in the mining space as well. That needs to take place. And patience continues to be a virtue in as far as waiting for this to happen. And as long as you're not on margin and you invest in the right companies, then you're okay. It's just going to take a little longer.
Dave, what about developers that are going into an announcement regarding a mineral resource update? I've been disappointed myself holding some developers where good management gives guidance and they say, we expect to meet this mark, and then maybe they come up just short of it, and then the market they're down 17% on the day they announce it. If I was the management, I would be like, that'd be kind of discouraging, right? Because it's not easy to put out a mineral resource with everything you have to do to get there. So yeah. What is your thoughts on that? Like, do you monitor how much success is built into the stock prior to that announcement to where you might sell and then just buy it back when it falls 25%?
No, I can't do that. I run a newsletter where, I do all this due diligence in a company, and I buy the stock, and my subscribers see that I'm buying the stock, and I'm not going to try to trade in and out of it. I believe in this, in the company. I've done all this due diligence, in most of the companies I've invested in, I've had previous success with the management teams that are running that company. I know how they operate. I know they're stewards of good stewards of their capital. I know they raise money at the right time. I know they put most of their money in the ground. I know they're aligned with shareholders. So I know they're just as frustrated as I am if they have to accept a finance in the market at a lower price than they expected, and they had to give up maybe a half a warrant that they didn't want to give up, or something like that, or terms that they're not really happy with. I know they're as disappointed as I am, and that's what you want to see. But getting back to your question, this is a market, Bill, where us resource investors and speculators have been trading amongst ourselves. Mostly savvy investors in the sector left, and there's also funds that know how to game the sector. So if they know that news is coming out that might be short-term bullish but long-term bearish, for instance, if a company puts out a mineral resource, right, but they see that, hey, they're going to need to raise money in 6 months or 8 months or a year, so they'll short the stock. And they can play these games with these low liquidity times that we're in right now. They could keep doing this. I had a company last week. I sent the CEO an email saying, wow, where did all this volume come from? You released really good results and you had this huge volume. Was it a fund cleaning up their position because on really good news so they can get a better price? But the next day, you had a huge drop in the stock on no volume. I had to say, well, what's going on here? And he told me that I was correct on the first item where, it was a fund cleanup, getting rid of the position on good news. A company releases great drill results. It's good news. It's a liquidity event. They know there's going to see some buying in the stock, and the fund gets rid of the position. Okay. The stock didn't move much on that, right? And on a huge volume. The next day, like I said, it was a huge red candle in the stock on no volume. But he told me that a bank offered them a bought deal finance, which they didn't need. He's like, I don't need this. I've got a great balance sheet. I don't need money. I don't need this charity flow through bought deal. Thank you very much. But word got out that it was being shopped. So, these funds get wind of this and they short the stock. And they were able to short it because there's nobody there to buy it in these illiquid markets. And the stock is still trading at this discount. Nobody's come in and cleaned it up. But the company still has, a great project. They're putting out great drill results. They're about to put out a feasibility study. They've got multi-millions of ounces in the ground in a top-tier jurisdiction. They're cashed up through 2024. But this is what happens in these markets. And, I'd hate to be, an ill-advised investor to be frustrated and say, look at this. This is ridiculous. I'm losing money in these stocks. I'm going to sell. And 6 months later, the gold breaks out and all these stocks are just going crazy because the generalist investor finally comes into the sector after we see the breakout. That's when the momentum players come into this sector, after we see the monthly close above $4,100 an ounce, right? And then the momentum players get in and retail gets in and people start to get excited. This is a really tiny sector. It doesn't take much. So these are the kind of things that are happening.
So what you just laid out there, like you learned experientially and by contacting management to say, I'm observing this, what's going on, explain it to me. And, you and I have talked in previous months that you're 2 decades into this and every week you learn something new about how this market operates, right? Just to encourage every day.
Yes, it's incredible. It's an incredible education. Bear markets are incredible educations, especially when in these low liquid circumstances. And you see all these things happen. And, since I'm fortunate to have these great relationships with these companies, I could just send them an email and they'll tell me right away, this is what happened, So it just gives me more confidence that, hey, I'm on the right track. I know this is coming. I know the gold breakout is coming, but, I, like everybody else, don't have a crystal ball. I don't know when the date's going to be. And even if I did, what's the fun in that?
So, Dave, we see headlines out of Mexico regarding some junior mining reforms. What are the CEOs that are overseeing Mexican projects saying to you right now?
Well, basically, they're saying that this is bad news for companies that want to come into Mexico and they need permits. They need to get those mining permits. The companies that already have them, the companies that I'm invested in there's 4 of them. That I have 4 companies that I'm invested in that do business in Mexico. These laws don't affect any of them. They've already got 50-year mine leases on their properties, and they've already got water permits and everything that they need, and it doesn't affect them. So I think it's going to be bad news for anybody who wants to do business in Mexico after just acquiring a project.
Okay. And Dave, your website again is juniorminerjunkie.com. Still room in the subscription if people want to sign up?
Yes, there is. Plenty of room. Bill. Come on by.
It tracks the gold price. It tracks gold sentiment, right? More so than the gold price.
Yes. I mean, this is the time to accumulate, when everybody's hating the sector and we're knocking on that $2,100 door again. So
excellent. Well, Dave, thank you for the May update, and I look forward to chatting with you on the show in a month in June.
You too, Bill. Look forward to it.